Welcome to the show. This is the Build Big, Live Bigger podcast. This is where you get real clarity about retirement so you can build a plan that blesses your life instead of becoming it. We'll share what you need to hear to replace worry with confidence, protect what you've built, and actually live your dreams, not your fears in retirement. Let's dive in. I've got my hidden drink here today.
Yeah, it's not the marketed one, right?
No, this is the marketed one. It's just there's Celsius in here. Yeah, 200 milligrams caffeine. So it should be a good episode.
It should be.
Yeah.
Gotta get your caffeine in.
Welcome to episode 2 of the Build Big, Live Bigger podcast. I've got Luke. He's from New Zealand. I continually make him feel uncomfortable, and that is accurate. Yeah, a part of my role here at Big Money. But I really want to talk today about something we're highly passionate about, which is our investment philosophy, how that impacts our clients, why we do what we do the way that we do it. I think this entire team really cares about our clients, and we really try to look at it from the angle of if these were our parents. A lot of our, team is in their 30s. I think our average age is like 35, but the team's younger, and we really take that view of if this were our own parents, what would we be doing with their assets? And I think we do a great job of doing that. So if you had to describe our investment philosophy in 60 seconds, what would you tell someone? Like, how do we invest money?
So I have a list of our investment principles here, but if I had to put it into 60 seconds, in the very beginning, it has to be goal oriented. So we all start there. So and there's 3 buckets to work with. You got your cash, you got your safe money, you got your growth money, and that all needs to balance in alignment with your long-term plan, like through retirement. And how is that going to supplement you with Social Security, with other income sources you might have? So that's really where we start, is the income plan. That's number one. And outside of that, on the growth side, we optimize as best we can by being long-term oriented, being goal-focused. We focus on quality investments. We focus on fundamental analysis, buying and holding. And on the safe money side, finding investments that can provide the best return comparatively, but also with no downside risk, because obviously that's super important to the plan. And in 60 seconds, I think that's probably the most potent explanation.
Yeah. And I think that was great, but I think a lot of, you really focus on the growth side. Like whenever I think about you as the lead advisor, I think you think about how do we get the money to grow as much as possible in the stock market, which is really a piece that, we've always had, but I think you've just added an extra depth to that.
Thank you. And it's very exciting.
Yeah. And you really work harder on the investment committee. So the investment committee meets once a week. You guys go over everything that we're currently using. Should we make any changes? And you guys are always chatting one another I think I was getting, probably 10 to 20 messages yesterday in that group chat, just talking about what we're currently doing and new ideas. So if you want to talk over the investment committee and kind of how we make a decision as a group as to what to use for our clients, it's not like we don't, a lot of people say tailored approach, and I agree with that. Every client is tailored, but for the most part, you do need systems where everything's easily implementable. Like we can go in and implement at scale and do a really good job for clients without trading in any one individual account every day or something like that. So talk over the investment committee and kind of your role there.
Yeah, sure. So again, this comes back to efficiency of our systems, scalability, but also what can be customized for clients specifically, each person specifically. And again, that's a balance between, growth and safe money, cash. But anyway, when it comes back to our investment committee, we have a group of us that are on the investment team that we meet weekly right after our first meeting on Monday. And usually those meetings are super insightful because we have minds from so many different areas that can contribute and provide insight, because no one knows everything. And there's so many things that each of us can provide and bring to the table. Like Matt, for instance, he's been an advisor for 11 years now, so he knows a whole lot about the industry, investment options. Mael, he's a younger guy, but super smart, super quick, very up to date with current trends. And me, this has been my passion for going on a decade when it comes to the investment process. doing due diligence and finding good, accurate process to produce the best returns. That's really where my passion is. If I can continuously look for better investments and optimize portfolios, making them better, that's really my passion. I'm excited to dive into that today.
Yeah, me too. So a lot of what we try to do on the investment team is focus on the three things that are in our client's control, which is the amount they pay in fees. So how do we limit that as much as possible while still providing return? Like I would be willing to pay, 1 to 2% per year for something if it had an outsized return.
Yeah.
But the amount of funds that do that are literally slim to none, if any. So low costs, we really try to stay under 10 basis points. If you don't know what a basis point is, it's essentially a percentage of a percentage. So if you said 100 basis points, it would be 1%. So, we're typically trying to find something 10 basis points or less, I think, for the most part. So limiting fees, taxes, that's a big piece. So whatever fund we buy, if we have a client putting in after-tax money and that's a taxable account, how can we limit the taxes? And then how can we diversify that money as much as possible? And before the investment committee was ever started, a part of what I did is, as a firm, I say it often, but we spend about $60,000 a year on software to be able to do planning. A part of that software stack is we are able to see something called a 13F filing. A 13F filing is essentially if an advisor has over $100 million in assets under management, what they have to post what they buy for their clients. So, I had been really big into Tony Robbins' Money Master the Game. It's probably one of my favorite books. He also co-wrote a book with Peter Mallouk called The Path. So anyway, once I launched the investment advisory side of the business, I really focused a lot on trying to find large investment advisors that had that same idea. How do we limit costs to clients, not generate an enormous tax bill every year on those gains? And how do we diversify the money as much as possible? And before you guys ever got here, I had already had like our one major portfolio still that we use every day, which is Follow the Smart Money. And I think we still use that portfolio probably more than any other portfolio. But kind of what was your review from the outside looking in whenever you saw that initial foundation that I had laid on the investment side with Follow the Smart Money, like pulling from an advisor who had been in business for half a century and had $220 billion in assets under management? Literally all I was doing was, I don't want to say copying, but for the most part, I was taking their best holdings, pulling those over. And that was really the portfolio that you saw first whenever you came here. So kind of what was your initial thoughts of that type of strategy following the smart money? And then how have you guys kind of layered on and added new portfolios for our clients over the last year?
Yeah, sure. So I definitely identified with that process of following the smart money. You don't get extra points in this business if you come up with your own ideas. So a lot of the great ideas are out there already on 13Fs, and 13Fs, that's an SEC filing that comes out every 45 days after the quarter, and it shows what they hold, what they've bought, what they've sold. And so watching one of these major money managers that you follow, and really just picking and choosing from that top range of what they own, I think it is very prudent. And it's the core of a great process. I mean, you don't need to come up with your own ideas. There are a lot of great ideas out there, and I come up with lots of good ideas on my own, but you don't get extra points if you come up with your own ideas.
Yeah, I agree. And, there are a lot of firms that have the same investment philosophy that we do. They're like, hey, buy low-cost index funds. But the only issue is a piece of where we've been able to cut a layer of costs and we pass that to our clients is the investment committee. So literally we have our top advisors at the firm building the portfolios and implementing the portfolios on behalf of the clients, which normally, if you're watching this on video, you would have, and if you're not and you're watching it on audio, I'll explain it, but you have three layers. You have the advisor, you have the money manager, then you have the custodian. So normally, I would say probably 95% of fiduciaries have a money manager in the middle. So even if they have that philosophy, those money managers do not work for free. So they're still having to pay a third party to get access to these portfolios, whereas we cut the middleman out altogether. And that's literally clients coming direct to us, and we're the ones placing the trades, and we're the ones implementing the strategies. So we eliminate a third of the cost, and we pass that on to the clients.
Yeah, totally. And when it comes to like mutual funds, for instance, a whole lot of them are very high cost. Those are people, behind the helm trying to manage the money, making the trades, trying to beat the market. And a lot of the time they don't, but they're also charging high fees. And that's really not what we do. We go for instance, low cost ETFs, which have very, very little expense ratios. And that really cuts out a lot of the fee for clients.
So we use ETFs, which, if you're new to this world, that would be an index fund for the most part. Most of them are index funds. But when you use an index fund, you don't have to worry about buying and or the trading activity from a mutual fund or from an individual security. Basically, it buys a basket of stocks. It's very low cost because it's passive, like the S&P 500. You get the top 500 stocks in the United States. Sometimes that ranges. It could be 480 companies on that list. There could be 503 companies on that list, but normally it ranges around 500 companies, and those companies are purchased based on their overall market cap in the economy. So if, for instance, Apple's worth 7% of the overall U.S. stock market, is worth 7% of the S&P 500. Kind of talk through an index fund, how that works, and why, in our opinion, it's better to use those.
Yeah, sure. So there's a lot of jargon around these different terms. There's so much jargon in our industry, but I'll give you a little more of the complex version, and we'll give you the simplified version. But the more complex version is that, so there are index funds, which are passive, and then there are actively traded funds. Either of those can be mutual funds or ETFs. So mutual funds, like the old legacy version of funds, then they have an X at the end if you want to identify them. Like, for instance, AABXX, it'll have an X at the end. That's how you identify what a mutual fund is. But that was like the legacy version of a fund that you can buy into to be diversified and have someone manage the money for you. But there's a modern version of those funds called ETFs, or exchange traded funds. They're way simpler, and they trade like a stock, and they only have one expense, which is the expense ratio. As opposed to mutual funds, they have a long list of different expenses that could catch you out depending on your situation, depending on what type of mutual fund you're in. And we can get into that in a couple minutes. But really, either of those, or basically the large majority, almost all of ETFs are passive. They follow an index, like a huge majority of them. And that's why we like to stay there, because they simply have one expense. It's very easy to understand them. And they're very likely to be passive and track an index, which usually does a lot better than most money managers at mutual funds, which are usually very actively traded and have lots of different expenses here, there, and everywhere.
Yeah. So how does an index fund work? Like, how does the S&P 500 work?
Yeah, sure. So we have multiple ETFs that follow the S&P 500. We use those for clients in a lot of our model portfolios. So the S&P 500, the Standard & Poor's 500 index. So what that is, it is basically the index that the fund tracks. So basically, since 1957, the Standard & Poor's 500 index was created. That's when it began. And so since then, it's grown at around 10.4% since then. And how did it do that? So basically, it invests or tracks the 500 biggest companies in the US. It's a super simple formula. So basically, the biggest 500 companies in America, they get added to the index. Once they become big enough, they get added into that 500. And then they are just buy and hold. And they're weighted, basically within the index, they're weighted based on how big the company is. So how big the company is based on what it's selling for on the stock exchange. And also just more jargon, but it's basically float adjusted as well. So it's like if there's a major owner of the company, that doesn't count toward the weighting. So we take that out, we see what's publicly tradable on the exchange, and that weight goes into the index. But yeah, in a nutshell, it's basically the biggest 500 companies consolidated into an index which funds can track. And that has been really one of the most successful strategies that there is. And it's one of the easiest as well. We don't need to worry about buying and selling. It's all just there.
Yeah.
So
Well, I think there's been a large movement from mutual funds, especially in the 90s, early 2000s to now 2025. I think more and more investors are becoming aware of the fact that they can limit their expenses. And there has been this shift from mutual funds to index funds because you have that transparency. You don't have to worry about trading risk. So there's not, some guy can't go into the office and be like, oh my gosh, I'm really excited about this idea. Let me throw, 5% of this mutual fund in what I think is a great idea. And then it ends up plummeting in value, which is why 92% of mutual funds fail to outperform an index fund. So literally when a mutual fund, they start a mutual fund, they have to name a benchmark index. And 92% of the time, we know that they fail to outperform an index. So I think it's a fading, if you want to call it fad, in the investment industry. Mutual funds are. I think eventually, like the younger generation will catch on to the fact that ETFs produce outsized returns. But one of the big reasons why I love ETFs is I love the ease of trading. Right, you can go in if I want to sell an ETF for a client today. And it's what time is it now? 12:30 in the afternoon on a Wednesday. I can go in and click sell, and by 12:40, they're out of it. Whereas a mutual fund, you would have to wait until 4:30 in the afternoon. But I think you have always been really bought in. So, over the last 10 years, you've really been investing your own money. And Luke, by the way, has done a great job. I think you probably saved more than any, young guy that I've met. So, it's not like the barber can't cut their own hair. Whenever I interviewed Luke, he actually brought in a fundamental analysis of different stocks. So it's always been a passion of yours. I think you've done a great job. What is your personal portfolio average? Haven't you averaged like 15% per year or something like that?
So I'm not going to disclose everything because it's my full financial picture, but the one that I like to quote the most, which I would basically use as a proxy for how I would manage money for other people. I won't go into the holdings, but it's a Roth IRA.
Yeah.
It's basically the best account that a younger person can get into because it's tax-free and it can grow for the rest of your life tax-free. But basically, in that account, it's done just a smidge over 18% compounded annually. And compared to the S&P 500, the S&P in that same time period has done around 12.
Yeah, that's phenomenal.
So far, the process is working, but hopefully that, record continues for a long time because, that little bit of extra percentage points per year can compound hugely.
So what would you say to someone if they're listening right now? Let's say they've been working with an advisor for, 18 years, they're approaching retirement and they're like, Luke, I really trust this guy. Like, I go golfing with him once a month. He watches my dog when I go out of town. Like, me and this guy are really close, but I'm going through my portfolio. I'm looking at my statement, and a lot of the holdings that I have end in X. So we know it's a mutual fund. What would you say to somebody who had a portfolio that looked like that?
Well, I mean, in our Retire Right University seminars that we teach at, so one of the first things I like to do is I'd like to go to a website that can do an x-ray of what the expenses are in that mutual fund, because there can be so many expenses in any mutual fund. They can catch you here, and really everywhere in between. But like personalfund.com, that's a great one. You get like 10 free trials to put in a ticker. So you would look for the top holdings in your portfolio. You look which ones are the other mutual funds which have the X at the end. You put those in, see what you're paying in expenses, and that'll really, be telling and tell you
that
how much you're being
website's
charged.
Awesome.
Yeah, it is.
Consumers, like, if you've been with somebody for a long time, you're like, let me just check on my own. I want to do my own research, see if this guy's actually doing what's in my best interest. And you go in and you plug in some of these holdings. And the alarming part to me, well, there's two things. The first thing is it will tell you what funds you can buy that are much less than expenses, that have the same exact investment philosophy and have outperformed that mutual fund. So it'll give you ETF alternatives. I love that. That's an easy fix. But also the other thing is that discloses sales commissions.
Right.
Which, every advisor has to do. I just think more often than not, if you ask somebody how were you paid, they would tell you. But I've just interviewed so many retirees at this point, I don't think it's disclosed enough, but a lot of these mutual funds will have an A-share load. So, for instance, if you got a mutual fund from a broker, and it could be any fund, it could be an American Funds, JP Morgan fund, Fidelity fund. You don't really know. I mean, these large name companies do it too, but if you enter that mutual fund in, it could have paid that advisor 4.5% out of your pocket.
Totally. And that's like a legacy version of this industry. And that's really the previous fading out version that I wouldn't want to subscribe to because, with mutual funds, this is a great example. There can be a front end load fee, which can be as high as 5.75% right off the bat in the very beginning. So you get charged that immediately, depending on how much you put in again. But again, that's why mutual funds are so much more difficult to understand and do your due diligence on, because who knows where you could be getting charged.
Yeah, I mean, if there's a 5% load on a fund, that means on the front end, you just paid the advisor if you put in $100,000, you just paid the advisor $5,000 out of your pocket. On top of that, now it's got to outperform an index, which it fails to do 92% of the time.
Yeah, exactly. And like with an ETF, for instance, there's no other expenses beside that one expense ratio, which is super easy to see. You just Google it.
Yeah.
And so you don't need to worry about that whole other list of expenses that you get with mutual funds.
Yeah. So why don't we go back into Follow the Smart Money a little bit more, because I don't want to skip over this or, undervalue what it is that we actually do with Follow the Smart Money. So if, for instance, the investment committee's meeting and you guys are like, okay, we want to introduce a new portfolio. We're going to do a domestic stock portfolio, heavily weighted in index funds. Whenever you guys are going in and you're looking at a 13F from some of these large companies, what are some of the things that y'all are looking at after you see that it's a large holding from that company to determine whether it goes in a portfolio for our clients or not?
Yeah, sure. So again, we just stick with ETFs, straight off the bat. We don't really even look into mutual funds because it's just way more due diligence. There's way more expenses. It's more complicated. They're more active. So we just don't even go there really. So on the ETF side, when we start looking at that universe of options and the ETFs, yes, we will look at, seeing whether it's been, held by lots of great investors out there, like following the smart money. That's why it's called that.
Mm-hmm.
But then we'll take that and try and do some more due diligence and really filter out the best of the best, the cream of the crop in that section. So, for example, the filters that I like to use are, how much of a reputation do they have? Who is the provider? How good is their reputation? What index do they track? Because that's really important too, because some indexes can actually be quite active. Mm-hmm. They can, every now and then, depending on how big they are or how big a weighting is, can change. So as opposed to the S&P 500, all it does is that it tracks the biggest 500 companies in America and it just buys and holds them and stays with them. We look at how big the fund is by the amount of assets it manages, the expense ratio, the only expense ratio or the only expense that you can be charged. Also, how much is the turnover? Like how much is actually being traded in the fund? Like, for instance, if an index is very active, like it reweights regularly, there could be high turnover, and that can trigger taxes for you. How concentrated it is too, and sometimes that can be a good and a bad thing. Like, for instance, in the S&P 500, the top 10 companies right now are accounting for 38% of the entire index.
Yeah,
it's good and bad, because in a good way, you're letting the winners win. The winners are so strong and they're doing incredibly well.
You're not killing the daisies to water the weeds.
Yeah, exactly. And it's like we don't cut the flowers and water the weeds. We let it just grow, and let the winners win. If it has a right to become a big portion of that index, we're not going to cut it down. So how concentrated it is important. Number of holdings, like in the S&P 500, it's 500 holdings, which is very well diversified. How long it's been around as well, and just things like that. So yes, we'll start with what great managers or what great money managers own these funds, and then we'll put that through our own filters and filter through to really the best of the best.
Yeah. How much reassurance is it for our team, you think, to be able to pull from somebody who's got $220 billion in assets under management whenever we're sitting with a client? when we've done that due diligence on the back end.
Well, it provides a lot of confidence, obviously, because, if a company that big, managing $250 million or $250 billion, wherever it may be, if it's good enough for them, it's gone through their investment process, their due diligence process, it's very likely to be an extremely good investment.
Yeah.
So just having that as security on the back end, knowing that it's gone through that filter first before it's even reached us, that's a great key to confidence.
Yeah. I mean, a part of whenever I first started the investment advisory side of the business, I even looked at that company from an ethics standpoint. I was like, what do these people believe? Like, it's not even, sure, they're a large money manager, but so is BlackRock and, a lot of the large ESG companies, which, some of our clients don't agree with that stuff. So I think that in large part, it has to be first, they have to have strong ethical values, be someone who I would trust. Like, if something were to happen to me, I would be fine if, Samantha went and gave her assets to them to manage. So I think that, well, now it will be us. But I think that just that level of ethical filtering matched with the amount of money that they manage gives our team a ton of peace of mind. Like, we're not trying to reinvent the wheel. We're just trying to, one of the early things that I read, and this is not me telling you that, the results that you'll get with us are guaranteed. So don't, compliance is watching this, but, one of the earliest books that I read on index funds is it's not get rich quick. No, it's get rich for sure. Like, and I heard that, and that just resonated so much with me. Like, even today, I met with a retiree yesterday, and there's two sides of the spectrum here. One was a prospective client referral from a current client came in. The gentleman had probably 25% of his portfolio in crypto. Older guy, and I'm just like, man,
That's a lot.
That's a lot. Like, I don't know how you sleep at night. There's a lot of these things that you can make a ton of money on, but oh my gosh, it's not worth the anxiety level.
Yeah, totally.
In any way, shape, or form.
Yeah, like, I don't know if you want to talk about crypto at all, but like you said one time, if it went to zero, who's responsible?
Yeah, that's my thing. Like, who are you going to in everything, somebody's got to be able to be held accountable. And with crypto, like, who do you hold accountable? No one knows who made Bitcoin.
100%.
So it's just so, it's terrible, because honestly, the way that I see it is, if that ever went to zero, and there's a lot proving that it never would. So, I'm not saying that it will or won't. I don't have a crystal ball. But I think if it did, I mean, it would be terrible.
Yeah,
100%. To a
100%.
lot of people. And it's like, I don't even want to feed into, I'm fine making 9 or 10% per year. Personally, I don't have to average 20% per year. And I'm a young guy, but I just think a lot of that is peace of mind. And I'm not even entering retirement, but I just know, based on our clients, like, I can't imagine, trying to make 20 or 30% per year. It's like, no, let's just get you in a space where you can make low single digit or low double digits every year. That's that's what you need to shoot for.
Yeah.
And then on the other side of that spectrum, so had a gentleman come in, conversation went great. And really a lot of the things that I just said to you, I said to him. He was like, yeah, I think I probably need to liquidate that. I was like, I'm not saying for sure you can keep a portion in there, but, we'll need to look. But 25% is way too much. On the other side of that is, I had somebody come to us, current client, they've been with us for 7 months, referral from somebody else, another one of our great clients. She comes in yesterday, and, personally, this is what I believe. I believe we're the best in the world at creating confidence. And, sat with her. She was with a large money manager. She was with Schwab before, like Schwab corporate. She was like, hey, I want somebody local, comes in, sit down, we got everything set up for her. And I was really trying to tell her, you need to spend some of your money. Like, the way that we're going to set the investments up, like, your kids are taken care of. Like, you should really focus on spending your money. Anyway, we have our first 6-month review. She walks in, she bought a brand new car. She's like, I need to take a distribution. I bought a brand new car, and I booked a 3-month trip to, or sorry, not 3 months, 3-week trip to Spain. And she was like, I would have never done that if I wouldn't have came in. And I think it's just because what we say is so clear and so proven. We're not trying to reinvent the wheel. We're just trying to duplicate what's already worked, but just do it in the most prudent way possible.
100%. Like 100% security, safety, prudent process. It's been a proven process as well. Like, for instance, I would not want to retire just holding crypto.
Yeah.
Like, absolutely not. Like, and who knows what could happen to crypto? Where do you see the value in it? But like, if you actually own, for instance, on the growth portion of your plan, again, it always comes back to the plan. If you hold, low cost index funds that follow, for instance, the S&P 500, you actually really do own a portion of the productivity and the greatest businesses in America. Like, you own a portion of the productivity and development of America.
Yeah.
So, and knowing that, you actually own a portion of the profits of those companies, and those are going to come to you in terms of returns in many different ways. And so owning that is way more secure than, throwing it all on red, pretty much, like gambling with crypto. So like, for instance, with crypto, it's hard to know what it is worth. I don't know if it's worth $1 per coin or $500,000 per coin. I have no idea. But with companies that you can track, they actually produce profits, and you can base a valuation off of that.
If retirement clarity matters to you, don't wait. Text BOOK to 864-920-3155 or click the link in the description below to get a free copy of Jonathan's book, Retire Right.
Well, I think back to, going back to the follow the smart money approach, we've implemented so many new portfolios, but whenever I look at this year, in February, there was that big drop in the market. Follow the smart money, our original portfolio, like the flagship, dropped by like 1%.
Wow.
It wasn't major. And anyway, when all the domestic indexes are dropping by, 10 to 12%, like we're down by 1. And I think that it's so important that we showcase that with our clients, because they're all about risk aversion. But not only that, it's producing a great return. So, I think the way that we do that is great, but that's not the only thing as it pertains to portfolio construction, especially our clients who are higher net worth. I think about some of the folks who have saved, over $1 million, over $5 million. You start to get access to more investments. And that's one of the things that you guys talk about weekly too. That's, I got a message about one of our funds that we're using for accredited investors, but talk about the different alternative asset classes that we've been looking at for higher net worth clients, how to generate returns maybe in a down market, and what we use to spread out the risk using those.
Yeah, sure. So, two options that we work with for high net worth clients. If you're accredited, so that's if you have $1 million in investable assets or more, or you make over a certain income limit. So there are investment options for them that no one else has access to. For instance, energy investments that actually can be a very smart, prudent, proven investment option, especially if you want to deduct taxable income. So some investments, like certain energy investments that we work with, when you put your money in, it's actually a tax deduction in a large part. And then you get cash flows from the production of that company. So that's a great option. Second option is also...
And how did you hear about that option?
From you. Yeah. So again, it's a consistent learning process. Like, there's certain things that I've learned here. Well, there's a lot of things that I've learned here that I didn't know before. But, building that context over time and then doing my own research, and, I'm really building a big base of knowledge there. But another option also is private equity as well. There is a certain provider that we work with, that provides private equity exposure. And getting into that can be, game changing as well, because private equity over the past, I think it's 20, over the past 20 years, private equity, the whole market has done 13.1% versus the S&P of 8.6% over that same time period. So those little extra, percentage points per year can really compound. So that's a great option for high net worth people.
That wouldn't be the bedrock of anyone's retirement plan, but those are ways that you can produce consistent income in down markets. And not everyone fits into the mold of, what we would use for a client under $1 million in net worth. It looks totally different for someone to do that plan versus someone who has over $1 million. And I think that the folks who have over $1 million, they want access to those things. Like, they can't get those at Fidelity. They can't get them at Edward Jones. They can't get them at Schwab. And it's because those advisors are they're stuck to, not stuck. They're all great folks who work there. Like I've met advisors at every firm in the world. They're all great.
But they're probably in a box. There's a limited amount of stuff that they can do based on what their company does.
Correct. And whereas when you hire an independent advisor who has access to everything, and especially a fiduciary, they still have to follow fiduciary guidelines, and you're not getting into anything that's commissionable. Any of the stuff that we use that is like a private placement or an alternative investment, we don't get a commission. Like we would just charge a fee to go into those products. But I think that, if you are looking at alternatives and putting them into your portfolio, I think it's a great idea. You just have to get it from the right person. You can't go out and even I've had the wrong side of that spectrum. So I've had someone, older gentleman, came in the office, current clients, over 70. He spent all of his time researching private placements, and he probably bought 10 different private placement investments. Out of the 10, I think 3 of them are producing returns. The other 7 aren't doing well. And it's because they were all commission based, and he got them all from brokers. And I think that you just have to find someone who you can trust and then ask them about those options, especially a fiduciary advisor. You would want to ask them, hey, what do you have access to that maybe I wouldn't be able to get access to
100%.
My box firm or wherever I'm using that.
You definitely, 100%, you want to go through a fiduciary because like as we know, they not only morally but legally have to put your interests first.
Correct.
The client's needs first, not their own, as opposed to a broker.
Yeah, the other thing that they're going to do is, I love a lot of these, all the private placements that we use. I'm the front runner for the firm. So like
I'm biggest investor in both of those options that we have.
So any of the options that we have, I'm investing my own capital first. And then after me, the clients are going into it. So I think whenever, when our clients know that, hey, we're using the same thing that you're suggesting. Also, I've had to back some clients down before. Like I've said, hey, we want to use XYZ private equity investment. This is how it works. Read this book. Make sure you understand it. As long as you can explain it back to me, we can use it. I just really want them to know everything they can. I probably delay them putting their money into it for 6 months by doing that, but it's okay.
Prudent process, right?
Correct.
Do it right, do it once, do it right.
Yeah, slow is smooth, smooth is fast. So, we go through that, and there's been times whenever I've shown a client, like I can think about one gentleman specifically, but I'll send him a book. I'll be like, hey, read this. Let me know if you think this makes sense for you. He'll be like, yes, Jonathan, it makes sense. I want to take 30% of my net worth and put it into this. I was like, no. Like we can do 10, but I think a lot of times a good advisor is actually going to undersell a strategy, and be like, no, we need everything to work together. Like we shouldn't. We love index funds; they're the most prudent way to invest money. That over time we know what they'll produce. But private equity, energy investments, they're great, but you don't want to put way too much of your capital. And I would say no more than 10% in either sector.
You don't want to bet the house on it.
No,
you want to be well diversified.
Yeah. So, we've really been talking for the most part. You said 3 buckets. You said growth, income, and cash. And we can hit on cash next just because I think it's
simple,
the easiest thing to do. And the investment committee, you guys are meeting weekly and you're all constantly bringing this up. But what are y'all looking for whenever you're looking for a cash bucket? You're looking for 6 months of client expenses. So like if it costs a client $5,000 a month to live, okay, we need 30 grand in emergency cash. What are you looking for in emergency cash portfolio?
Yeah, totally. And so that's where you start building it from the ground up. That's where we kind of start with your plan. You need to have that liquidity, that cash bucket just in case for worst case scenarios. We like to say roughly around 6 months of cash in terms of your expenses. Because, for instance, if you lost your job, you have no income, worst case scenario, it takes you 6 months to find a new job, whatever it may be, you're going to be okay. You have cash on hand to get through the hard times. And also you might want to build in a buffer of, if you want to make a big purchase, that can be important to build in as well. And people have different risk tolerances as well. Some people are okay with 3 months. Some people are okay with 12 months. They need 12 months or more. Depends on your risk tolerance. But yeah, we usually guide towards 6 months. I think that's a pretty good, prudent amount. But even in that cash bucket, you can have it working. You can have it working reasonably well.
So what do you like when you're looking at something to invest that cash bucket into? What are you looking for?
Yeah, sure. Like for me personally, we have a few different accounts, but I can have basically a cash equivalent, like mutual fund. Oh, sorry, not mutual funds. Money market funds. That's a great option for getting a good yield on essentially cash, essentially a cash equivalent.
Now, should somebody go to a bank to find that money market fund, or would you just buy that on the stock exchange?
So again, I think the best way to do it is to go through a financial advisor, a fiduciary financial advisor, to help you set up that bucket. For instance, obviously this is time stamped for today, which is July 2025. But we have basically a world-class money market fund earning 4.23% right now. And that's on completely risk-free money that's just sitting there in case you need liquidity, because you can access it anytime you want, unlike a CD. So yeah, definitely going with a fiduciary financial advisor.
Yeah, and another thing and I think you've seen this since you came here, we don't really charge clients on that money.
No, we don't charge on cash or safe money.
Yeah. And a big reason why we don't do that is if you have somebody making 4.23 and we charge them 1%,
that's a quarter of your return gone.
Correct.
Yeah.
So, and I think that's, long term for us, I think it's more about client retention. And a ton of our business is driven off of referrals. I think the reason why we get so many at 34% of new business every year is because we do little things like that.
Yeah, totally. It's all about goodwill and reputation. I mean, we have nothing without a reputation. It's all about building good reputation. And basically that's just doing the best we can, for people. That's a great example of a value add.
Yeah. So the other thing that I want to talk about is the income bucket. So we talked about the growth bucket, which when I say Luke is passionate about the growth bucket, this guy does not. He has a family car. He owns a car. He just only has one family car. Him and his wife share a car. I think that is, I think that's hilarious. I think that's a part of like New Zealand culture, which is cool. But you can literally walk to work. You're 5 minutes from the office?
Yeah. In my situation, it works perfectly fine because I walk 5 minutes down the road here in Greenville.
He can afford a car.
Yeah.
He just does.
I can buy a car, but I prefer to not, because that whatever, $20,000, $30,000, whatever. I'd rather have that in a growing asset base like the stock market rather than having it just sit there in a car depreciating. Yeah. That's just me.
He could buy a Lambo. But, it's
kind of like Warren Buffett. Warren Buffett was very frugal because he'd rather have those dollars in the stock market growing.
Yeah.
So have you heard
the story about Warren Buffett, his breakfast sandwich choice? Have you seen that?
Yeah.
Can you explain that?
I don't remember the numbers exactly, but basically he would go to the McDonald's on the way to his work every single day. Yeah. And his wife would either put...
which is hilarious because he's 90, eating McDonald's every day.
But his wife would put in a certain amount for one meal and a certain amount for a different meal. And he would basically choose whichever option based on what the market was doing. So that day, if the market was up or down, if the market was up, he might feel a little better to get the more expensive meal, which would be like, $4?
I don't think it was that much. I think it was like $3 and some like $3.30.
Yeah. You get like a bacon and egg McMuffin or something.
Bacon, egg, and cheese.
Bacon, egg, and cheese.
Yeah. So the market's up, he gets a bacon, egg, and cheese a little bit over $3. Market's down, he just gets a sausage and egg biscuit, which is like $2.60. That is absolutely nuts to me.
I'm not that crazy.
Yeah. Yeah.
I like to stay frugal and invest.
Yeah, I love that. I'm just telling you that because, I know you're extremely passionate about investing, so I love that. But then you go to the income bucket, which, in my opinion, is the most important part of a retiree's plan.
Yeah, especially for retirees.
Confidently generate income every single year. So before you got the big money, tell me what your philosophy was around the income.
Yeah.
Like if you thought about an income bucket before you ever got here.
Yeah. Well, again, it didn't really apply to me going into previously in my life. I didn't have to worry about my income bucket because I can just work. I'm young.
You worked at an investment firm. So I'm saying if you were looking at a client's income, like what would you be looking at?
So yeah, traditionally, and also going into my last job, it's all about, on the safe money side, bonds. So like getting a good yield on bonds, maybe CDs and money market funds, and that's really it. But coming here to big money retirement, there are actually other great options that I had no idea existed before I even started here. And it's because the US system, the US financial system is so much more developed than a country like New Zealand. But yeah, we just depended on bonds really in the past for the safe money side.
Then charged a management fee on those at your previous employer.
Yep, that's
But
true.
The thing, now we're going back to that question of how much of your return are you giving up. I would say probably 80 to 90% of advisors are doing that.
Totally.
Fiduciary advisors are doing that for clients, where they'll get a bond that may pay 5%, but they're paying a 1% management fee or 1.5%. So they're giving up anywhere from 20% to 30% of their return every year in fees.
Yeah, totally.
So that was one of my big things. I was like, okay, how can we do this without charging a fee, still be profitable? Because that's one thing too. Like, I'm not saying that everyone who charges an income fee on an income bucket's a bad person. They have to, make their
lights on.
Yeah, they have to keep the lights on. Like, they have to make money somehow. But the thing is, I knew how much that was impacting our clients, and I was like, are there any alternatives out there? And that was really where we started to look at insurance products, specifically annuities, which are a lightning rod. So you say that, and somebody right now is listening to this, and they went, yeah, I don't know about this anymore. But the thing about, if you get an annuity from the right advisor, they work. But you have to filter through the lens of the client. You have to say, what's going to pay the client the most amount of money? It's not what pays me the most amount of money. One of the pros of an insurance product is you can eliminate advisory expenses, and it pays the advisory firm who you got it through, and it doesn't come out of the client's account. So yes, there is a lot of people think that all commission-based products are bad, but in reality, they're not. You just have to get them from the right person, and that commission has to be disclosed. And then you have to, like, if an advisor were giving you a recommendation on a commission-based product, they would have to show you all the products that were out there and the subsequent commissions on those products. So you know that basically what they're stacking of is not based on what it pays them, it's based on what it pays you. So, I want you to go into like your entrance into the insurance product world, because I know that we used them a lot before you ever got here. But your entrance into the insurance product world, what you thought initially, and then what you think now. But I also want to insert a story. Matt had a client yesterday. They were in yesterday for a review. Met with them. They, high net worth client that had saved, I think, $2.5 million. They come in for their review. They were looking at an insurance product, the annual review of what it made $120,000 in gains on an insurance product. And they didn't pay a fee. They had $990,000 in it. So not quite $1 million. They had $990,000 in it. It paid them, right at 12% of the total account value, or a little bit over 12. But the thing is, they didn't pay a fee. They didn't take any risk. And that $120,000 that account made, it was a permanent gain. So, I know if you get them from the right person, they work. And then now they're talking about, where are they going to go on vacation? What are they going to do? Things like that. But just talk to us a little bit about maybe your idea of insurance products or annuities before you came here, and then kind of that aha moment for you where you were like, okay, these actually can work really well.
Yeah, sure. So, as you said, a portion of my personality is being close to an Enneagram 6, which is a loyal skeptic. Keyword being skeptical. So, like, going into, big money retirement, we did use fixed index annuities. That's a great option on the safe money side. And I had no idea what that was. I had no previous exposure to it, especially coming from New Zealand. And so it took me a while to kind of acclimate to that idea and understand under the hood how it works. Because again, for me, I'm trying to understand it fundamentally, not just on the surface. And so basically, the idea of what insurance companies can do is they can provide a product that can give you a cap following the market, but up to a cap, a certain limit, but a floor as well, so the money can't go down. And I'm thinking, how does that work? How does that fit in? Because like naturally, I'm thinking, how do they make money? How does everyone make money here? How is it safe, etc. So again, I went through my own learning journey behind the scenes on how does it all work? How do they provide that kind of product? Because sometimes it sounds too good to be true.
Oh yeah, 100%. Yeah,
There's like a 11% amount you could make in a year on money that can't go down, that you can access. Like how amazing is that? So how does that work? So yeah, initially I had trust, but I was skeptical. So I wanted to look into it and understand it myself. So researching it since then, I have had basically a full turnaround. Like I have full confidence in it now, because I can understand how the insurance company operates behind the scenes. So the insurance company, they'll take your money. They'll basically buy bonds themselves. So they'll get bond exposure. With the money that they make from that yield, they can then buy options, which it gets a little bit more complex from there. But that's basically how they can risk-free provide that window that you can make. It gets a little complicated, but basically that is how it's designed, and they price in their profit there. And whenever, a fiduciary like us would recommend it, the insurance company pays us. It does not come out of the account, which was awesome to see. Yeah. And so basically you have a product that there are no fees. There's any kind of fees on the client side. And you have
the right. They do have, some of them have fees on them, but if you get the right one, it doesn't have fees.
Yeah, exactly. And that's where it comes back to doing this through a fiduciary financial advisor, not a broker. Yeah. Being held to the fiduciary standard, we have to put the client's, that person's needs first, 100%, as opposed to a broker. But yeah, so having a product that can make that market upside with no downside, that was a foreign concept to me. Yeah. But now, I can see that it's really incredible for retirees. Like, for instance, along my learning journey in that first year or two, I saw one of those statements for one of our clients that had made just over 23% in 2 years on money that couldn't go down because they hit the cap twice in a row because the market was going up. So that was, pretty incredible to see.
Well, the good thing is, as you're going into retirement, you want that peace of mind. And to have something like a bond that if interest rates were to rise, you're going to see your account value go down, that's not driving confidence in your advisor. So I think that it's the perfect middle ground where we can say, okay, how can we use index funds, ETFs? How can we track ETFs without any of the risk? So we're using our investment philosophy on follow the smart money and everything that the investment committee does, and we're just basically putting that into a buffered solution. So when the stock market goes up, yeah, you have a cap, but you also have a floor, so the money can't go down. But one of the big aha moments for me, whenever I was thinking about implementing this at scale for our clients, that's always been the big thing. How do you implement this at scale for multiple families? How do you generate the income that they need in retirement and doing it in a way that it works for all parties involved? The thing that was so reassuring to me is when you track an index like the S&P 500, it's super predictable. So I'm going to go into the weeds a little bit, not a lot, but when you use a point-to-point strategy, which is the strategy ideally that you would use, it means that you follow the index from point A to point B. So the year that you get it, let's say you get it in 2025, July of 2025, somebody becomes a client, they put, X number of dollars in a fixed index annuity from July 15th of 2025 to July 15th of 2026. Whatever the stock market does, or the S&P specifically, they participate in that full upside up to a specified percentage. And rates vary by company, but, let's say 10%. So they would do up to a 10% annual return. I love that. The thing actually that I love more, that it takes a while to explain it to a retiree, but they get it. When they get it, they understand it, is the annual reset feature. So if that works great in a good time, but Jonathan, what about a bad time? When the stock market goes down by 30 or 40%, a lot of people are like, oh my gosh, I have to go back up to where the stock market was to make money. Not in a point-to-point fixed index annuity. If the S&P's at 6,000 today and it drops down to 3,000, you didn't make any money that year. So let's say you put $500,000 into that account. You wouldn't have made anything. Your $500,000 stays $500,000. But that following year, you only have to make money from where the S&P dropped, which is super easy. If the stock market were to drop and go all the way down to 3,000, more often than not, it's going to go above 3,000 again. So the thing that was easy for me on implementation for clients is I was like, okay, well, if you have a 0 year, typically the next 2 to 3 years in a row, you'll hit that specified cap. So if we ever get together for an annual review, typically the next 2 to 3 years in a row, we're making that 10% annual cap. So explaining that based on the statistics to the client, it's not a guarantee. You could have 2 negative years, but rarely has that ever happened, if ever. But if you do hit that 0% floor going back the last 20 years, typically the next 2 to 3 years in a row, you'll make the cap, whatever the specified cap is. And it's because of that reset provision. So it makes it easy on the client. I think a lot of what we do is, how do we set up a portfolio where if I went into a coma for 10 years, and again, I'm not guaranteeing results in any way, shape. Yeah, knock on wood. But I'm not guaranteeing results in any way, shape, or form. But if I went into a coma for 10 years, how would I know that the Johnsons or the Smiths have more money than what they gave me? And a lot of that is ETF driven on the growth side. And on the safe money side, it's something that's hyper predictable, like a properly structured fixed index annuity. So, a part of it is we want the client to be able to sleep good at night, but guess what? We want to sleep good at night too.
100%.
Like that's a lot of, you're talking about now we manage nearly $250 million. I sleep like a baby. Like,
because it's in great stuff.
Yeah, actually I have an app that, have you ever seen the 8 Sleep mattress?
No, I haven't, but I heard you talk about it on our Monday meeting.
Yeah, by the way, I'm going to go on a riff here. If you want to invest in your sleep quality, like you should totally do this.
That was really interesting. I feel like I want one now. So it analyzes your sleep pattern.
It analyzes your sleep, and it tells you exactly how long it takes you to fall asleep. And I mean, it's absolutely nuts. But anyway, so like last night, time to fall asleep, 20 minutes for the camera. Time to fall asleep on Monday night, 8 minutes. Like
I'll lay 8 minutes?
8 minutes.
Wow. Usually they take quite a while.
Yeah, I'll lay my head down. I'm out.
Really?
Yeah.
That's crazy. There's so much maybe it's just with my mind specifically, but it's like there's so much momentum.
Yeah.
It runs on momentum, and so it takes a while to slow.
Well, I'm a tech nerd on a lot of stuff, but yeah, as soon as I saw that mattress that it tracked your sleep, it adjusts the temperature at night too.
Yeah, now I want one.
Yeah, so if you fall asleep and it can tell you're not sleeping too well, it'll lower the temperature of the bed, so it'll make you
optimize
colder.
The temperature to make sure you're sleeping properly.
Yeah.
Wow.
And my alarm in the morning is not an alarm clock; it's the bed gets hot.
What?
Like crazy hot.
It'll just smoke you out in the morning.
Yes, 100%. I'm like, oh, I gotta get out. But anyway, you can't even stay in the bed.
That's crazy.
Yeah, it's cool. It's a really natural way to wake up. But anyway, going back to the investment side,
it's a great investment, by the way.
Yeah, it is a great investment. Yeah, I mean, you look at it, you spend the majority of your time either sitting at the office or asleep. I mean, you spend whatever 30% of your life asleep. So yeah, invest in it. But anyway,
we're not affiliated with any brand.
We're not. No. Go to 8sleep.com and enter Jonathan at checkout for 30%. Yeah, that's a joke. I don't have a discount code. But, I think that a part of that is we want to be able to sleep good at night. And by doing the things that we do the way that we do them, we are able to.
Yeah.
And the good thing is, especially on our team, if we ever saw an advisor, a co-advisor on the team implementing something that we were like, I don't know.
Yeah.
We would call that advisor out.
Yeah, totally. I mean, that comes back to the investment committee process. We need to kind of dive into that as well, because there's so much that comes to the table there on a weekly basis and in this company. So, I mean, we treat it like a meritocracy. Only the best ideas get through.
Yeah.
And that has to be vetted. It has to make logical sense. It has to be based on data, so that's really what makes sense. And we have principles behind that. We also have our own processes, but then we come together. We have that meeting of the minds, weekly, and we filter out those best ideas. Every now and then something new will come through that will be approved, but it's not very often.
Yeah. I mean, I think that one of the things that I never want to do is sit in a client review and feel like I've been called into the principal's office. You know that feeling where you're like, I don't really want to. I've never sat through a review and felt that feeling ever.
I mean, they're going to be in great stuff, great investments.
Correct. And it's not, you don't have to, when you get older, it's not about how much money you make, it's about how much money you keep. So, you don't have to make 13 or 14% per year. You really only have, I mean, in all honesty, you really only have to make 6 If you're only taking 4% of your, or 7, if you're only taking 4% of your portfolio, you need that 3% inflation adjustment. If you've saved the appropriate amount of money, some people haven't, some people have, but if you have, it's really 7% is the goal. Well, if you look at the way that we do things, the safe money, on average is made, let's say 7%. I know a lot of them have made more than that, but 7% on safe money. And growth in the stock market, we're making low double digits. That client is and we're not implementing crazy strategies. And if you look at it, if somebody's got $1 million and they're making 11% average over the last, 10 years, that means their portfolio is growing by $110,000 a year. If they're only taking out the 4% rule, $40,000 a year in income, their net worth is increasing as they're aging and they're taking out income. And it's not us swinging for the fences. We're just using proven strategies.
You don't need to take huge risk and try and swing for huge returns. I mean, it's really just, you got to figure out what the plan is and then figure out roughly, what your growth and what your safe money should be. You don't need crazy returns a lot of the time.
Yeah.
As long as you have the plan in place.
Yeah. And I think that what I just said for a retiree with under $1 million is everything that they need and more. The good thing about working with us is we've already done the work. We already have the portfolios, we already have the software, we already have and it's almost and
the context too of what not to do. Because a lot of what goes into investing and planning, 98% of it is what not to do as well. There's not the best. There's many products that are not very good. A lot of investments that are not very good. A lot of not very good opportunities. But what you see is the finished product of what we do, what we provide. But that is all. That's only the tip of the iceberg. It's not showing all of the back end research that is excluding all of these other things that we don't want to do.
Well, I think that, like I said, for a lot of folks, making that 9 to 10% per year will change their life because a lot of the big box firms out there, if you go in and you mark moderately conservative on your intake form, it's so dangerous to me to have an advisor and a complacent relationship for 20 years.
Right.
You want to see the firm that you're working with, the local firm that you're working with, growing.
Yeah.
Every time you come in the office, if you come in every 6 months, if there's not one new person on that team, in my opinion, the growth is too slow.
Yeah. Complacency is dangerous and expensive.
Correct. So, a lot of people are like, oh, I love this guy. I've been working with him for 18 years. But that guy's still got 2 people in his office. That's a lifestyle business. I think more than anything, we're trying to grow something that actually impacts people at scale. And we're trying to do it as quickly as we can without going too fast. But I think one of the things that I hear more often from not than clients is, oh my gosh, I'm so glad we did this. I have an extreme sense of clarity. But then as I'm walking them out of the office, they're like, who's this person? Who's that person? And it's because we're growing so fast, but it's because we want expertise and insight from, how many people have we brought on since you've been here?
Probably 10 or more.
Yeah.
Yeah, at least 10.
Chris, tax advisor, new lead advisors from different sectors. Maybe they had an active management background, passive management background, off fiduciary advisors, new onboarding folks, operations, service. Yeah, it's all developed over the years. But I think in a lot of ways, you should look. So a lot of what I'm saying, buy low cost index funds, all of that stuff makes sense. But also at the same time, if you're even working with an advisor who says to do all of those things, but they're not growing, you can't visually see the growth. I don't know. I think that you've got to see your money working for you, and you've also got to see the team that's working for you growing and it's expanding. That's just overall growth mindset. I think that advisor should have a growth mindset. Whoever is working for you, they should be trying to grow your portfolio as much as they can and grow the organization. If they really cared about their product, their service, everything that they were doing, they would be getting dramatically larger over time. And you should be able to visibly see that growth.
Yeah.
Whenever you make a decision.
Success leaves clues again. So they must be doing something right. They're providing good services, good products, good investments, good methodology.
Yeah.
So it's a sign.
Yeah. I think the other thing too is, average retiree under $1 million, that's all they need and more. They're not going to go to the big box firms. Over $1 million, that's honestly where I see us start to getting into that. We kind of get into a blue ocean where, you're getting that solid financial advice, but also at the same time, you're starting to get access to things that can produce outsized returns. And I think that, that's just common as you raise your affluency level. So like as you're getting more and more wealthy, you feel like you should have access to different things. It's like someone who's, done really well for themselves. Do they stay in the Holiday Inn or do they stay at the Ritz-Carlton? Well, they probably stay at the Ritz-Carlton. Why do they stay at the Ritz-Carlton?
Right.
It's the service, the experience.
Yeah.
You're going to get the same amount of sleep in both beds.
Yeah.
But it's the ambiance behind it. And I think that that's one thing that we've been hyper aware of as we're starting to deal with higher and higher net worth clients, $5 million, $10 million. We're really starting to provide that ultrasound advice. And they still use a ton of the same strategies with access to the alternatives.
Yeah. Like with alternatives, when you do get into that next sphere, of affluence and wealth, I mean, you have access to products that can potentially be, market beating. Potentially, it can be a great diversifier. There's, good diversifiers for your portfolio. And there's also, ones that can be very niche for certain situations, like, for instance, tax deductibility. There's options out there that can really be used to hone in on perfecting your plan.
Yeah.
Especially as a high net worth person.
100%. Well, Luke,
I feel like we're still just scratching the surface.
We are.
I have so much to get through. I've barely gotten through these notes.
Oh yeah, it's okay. We got tons of episodes to do on here, but I really appreciate your help as always. You're instrumental to the team. Everything you do here, you've made a huge impact, and
thank you.
Likewise. I think we're only scratching the surface with how many people we've actually helped, and I think that one of those testaments is 34% of our business comes from referrals every year, and we don't even ask. And I think that if somebody's watching this podcast right now and they're like, what's my next step? What should I do? Of course, they can come into the office, but honestly, some of the things that you were talking about, do your own research. Like if you've had a broker for 18 or 20 years and you don't know if they're doing the best thing for you, then go to personalfund.com, type in your holdings, do all of that research, make an informed decision. I think one of the things that I love about what we do, the way that we do it, is we're like, hey, if you want to do it with us, we want to do it with you. And I think one of the things that we've gotten more intent about is making sure somebody's a right fit from the get-go.
Yeah.
And just basically, we really work with people who we want to work with. And I love all of our clients. Like, I think that they're all super people. Like, I would hang out with all of our clients. If you wouldn't bring your client over to your house for dinner, you shouldn't bring them on as a client. But I'm just really excited for what we're building. I'm excited to continue on the podcast journey.
100%.
This is just the start.
Yeah.
On upcoming episodes, we're going to be talking about Social Security, taxes. We'll get Chris on a podcast. He's an enrolled agent with the IRS, but make sure if you haven't subscribed to the podcast, subscribe to the podcast. We love to hear your feedback, so leave your honest rating and review. And thanks for catching us on episode 2.